Yes, indeed. And actually, these are one of the three key risks that we see going forward that we also continue to reiterate to investors. This is number one, the U.S.-China trade tension, especially with, like you mentioned just now, Trump renewing the threats against China. And number two, that investors need to continue to pay attention will be the ongoing earnings season. So far, the numbers are overall better than feared. But then we are looking for example, 2Q will be within the range for the earnings growth to be within the range of 3 to 5%, especially with the earnings surprises will probably be weaker than last quarter. And most importantly, we'll also be looking out for some sort of negative pre-announcements or any negative guidance related to tariff. That will also spook the market. And number three, even though overnight we actually get a mix of positive equity catalysts, for example, better than expected June data, and also, for example, the numbers for the 2Q earnings numbers were overall better. Sure. And number three, we see that Chair Powell reiterating his dovish semi-annual testimony, even though we see some sort of improvement in the fundamentals over the past week. All these are like positive equity catalysts. But then the factors I mentioned just now, for example, the China trade tension and also the earnings, and also most importantly, we need to pay attention to also the U.S. July surveys, which might actually show a deterioration in consumer and also business sentiment.
Okay, fair enough. To the earnings question then, Marcella, because you're expecting U.S. earnings growth to remain between the 3 to 5% range. What does that mean in terms of corresponding levels on the benchmark indices, the S&P 500, the Dow Jones, which are scaling record new highs at a time when you need the earnings momentum to kick in, but it doesn't seem like that's quite happened just as yet?
This is actually an interesting divergence because we see earnings growth is no longer taking the lead, but instead it's actually the central bank expectations with regards to Fed or other central banks that are actually undercutting the multiple expansion or actually helping the multiple expansion. So going forward, it will mostly be the central bank expectation that will be helping the market to, for example, to come up with a new leads or how the central bank language change, and that will also affect the market sentiment.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.